How's it going, everybody? Mike Weber here. Today, I want to talk about how much you need to put down to be able to buy a home and also dispel some of the myths and rumors that have been floating out there over the years that I've been in the real estate business. So believe it or not, in my career, I've talked to many buyers that believe that they actually need to have 20% down to be able to buy a home. Now, some of them realize that the reason why they might want to do that is because they don't want to pay mortgage insurance. And other of those people have literally just been told that they can't actually purchase a home if they have less than 20% down. And in most all cases, that is absolutely not the case. So let's go ahead and jump right in. We'll talk about the different loan options that are out there and some of the benefits and detractors of each of these different types of loans that are available. So first off, option number one, we have the traditional conventional 20% down mortgage. Now, of course, you could put more than 20% down, but usually in the kind of low interest rate environment that we're in, most buyers want to finance as much as they can because the interest rates are so historically low. So most people tend to not put more than 20% down when they buy a home. Now, there's really two benefits to doing a 20% down loan. One is it's easier to get an offer accepted in many cases. And of course, having additional money on top of 20% can put you in a position to be able to cover costs like a low appraisal or other things that allow you to maybe get an offer accepted or to be able to buy a home that some of these other options may not allow. Now, secondarily, the other benefit is not having to have mortgage insurance. Now, a lot of people are very scared of mortgage insurance. They think it's like a terrible thing and you should avoid it at all costs. And that is absolutely not the case at all. Now, mortgage insurance typically ranges between 0.2 and 1% of the loan amount, and that's added on to the loan and that gets paid annually. And the amount that you actually pay is tied to how much you put down, what your credit's like, what type of loan you get, who the insurance provider is, and so on. And I often see it range closer to around that 0.5% mark. So yes, you do have to pay another 0.5%, on your loan rate. But we've been in a market for several years now where real estate prices are going up 10, 12, 15% a year. And so if you just do the simple math, if you end up paying 0.5% higher in a mortgage rate, for a period of years versus paying 15% or 30% or 50% more for a home 3 or 5 years later, the cost of paying that slightly higher interest rate is often minuscule to what it's going to cost to pay substantially more for the home 2 or 3 or 4 years down the road once the price has gone up, 30, 40, 50%. And many lenders will allow you to either petition or to have that mortgage insurance drop off of the loan once you actually get to 20% equity, which obviously has been happening very quickly over the last several years because of how quickly real estate prices have risen. Now you also can just refinance, assuming rates stay low in the future once you get to that 20% equity, to get rid of that mortgage insurance as well. So potentially you could only end up paying for the mortgage insurance for 2 or 3 or 4 or 5 years and then go back to having a lower rate. You don't pay the mortgage insurance anymore and you paid a far lower price for the house because you bought it earlier than having waited until you eventually saved 20% down in the future. So that all said, with option one, conventional 20% down or more, of course, there's no mortgage insurance. You get the best rate, and that's definitely a great option if you can swing it. For our second option, we have 5% down or less than 20% down conventional financing. Now, this is a great option for most all buyers out there. If you don't have 20% saved up, but you want to buy a house, if you have 5% or more to put down, This is a phenomenal option. Now, with this option, you do have to get mortgage insurance. And again, that's going to be tied to what your credit's like, how much you actually put down, what type of loan it is, who the lender is, who the insurance provider is, etc. But in most cases, the actual bump in interest rate is going to be relatively small. It won't affect your payment too much, and it allows you to get into a home now instead of waiting and potentially having to pay 10 or 20 or 30% more for the home in the future, which will certainly make your payment vastly higher than buying today with a slightly higher mortgage rate because of the mortgage insurance. With this option, it can be a little bit more difficult to get an offer accepted depending on the type of property that you find, but there's a lot of leeway in terms of what types of properties, the loan limits that you can use that keep going up year after year. And this again is a very good option and a pretty easy option to use to buy properties at most different price levels in our local market here. Option 3 would be 5% conventional financing without mortgage insurance. Now, there's a lot of lenders that are starting to offer these type of loans where it's conventional financing and there's no mortgage insurance, but the rate is a little bit higher than you would otherwise pay if you had a loan with mortgage insurance. But usually the overall payment works out to be less than the version if mortgage insurance was included. So this can be a really great option to do 5 or 10% down, less than the 20% threshold that you'd usually need to get at to avoid mortgage insurance, while just paying a slightly higher interest rate. So that way you could buy a property sooner instead of waiting. And then again, of course, assuming interest rates stay low in the future or become low in the future, you could always try to refinance in a short period of time back down to the lowest rate you possibly can. Option 4 is going to be FHA financing. Now, FHA financing allows you to purchase with as little as 3.5% down. Now, FHA financing generally has slightly lower rates, but it does have slightly more expensive mortgage insurance. However, it allows you to get into a home with very, very little money out of pocket. FHA financing can be a great option, especially for single family properties. You can also buy condos with FHA financing, but it tends to be a little bit more difficult to find condos that are going to be approved for an FHA loan and that also are going to be willing to accept an offer from an FHA buyer when they might have other conventional buyers with larger down payments for a variety of different reasons. But it's certainly not impossible, and people use FHA financing to purchase single family homes, condos, and multi-unit property that they're going to live in all the time. So this is definitely a great option if you can't quite swing the 5%, but 3.5% you can make that happen, then that is definitely something that you should look into. Option 5 on the list is going to be conventional or FHA financing with down payment assistance. So believe it or not, there is a plethora of down payment assistance programs out there that will allow you to use a conventional loan or an FHA loan with almost zero down or close to zero down in some cases. Now, the way that these programs typically work is either they'll give you some sort of grant or free money or money that ultimately becomes free after a period of time, or they'll give you a second loan that covers whatever that required down payment is, and in some cases, some of the closing costs. So that way you can buy the home and come into the process with very, very little down. Sometimes as little as closing costs, which generally range from about 0.5% to 1% of the purchase price. But in some cases, I've seen buyers come in with almost nothing down, or sometimes there's other options like getting the seller to pay for some of the closing costs, and then the first and second loan cover the down payment and then the rest of the loan amount. So this could be a great option. I have worked with buyers that have taken advantage of some of these programs and been able to get homes with these sort of low down payment options. So this is a phenomenal choice if you don't have much down payment, but you have decent income, you have good credit, etc. And finally, option 6 is going to be more creative financing scenarios that are typically going to be left more for an investor type buyer. Things like seller financing or rent to own or installment sales. There's always possibilities in any market for these creative sort of financing options, but these are going to be the most difficult to find. So I'm going to go ahead and leave these out and not talk about them in this video because they're a little bit more advanced and not what your typical buyer is going to do to purchase their first home. I hope this information was useful. So if you have any questions about how any of these programs work or just about real estate in general, feel free to reach out to me directly. I'll go ahead and leave my contact information in the description below. If you haven't subscribed, go ahead and do so. Let me know if you have any questions or you want to talk about anything in the comments down below. Thank you guys so much for watching. I look forward to seeing you on the next video. Take care.